Podcast. I'm your host, Josh Appleman. Today we're joined with Ken Gee. Ken is the founder of KRI Partners, has 26 years in real estate and private equity with over $2 billion in transactions. Ken is a former CPA at Deloitte and commercial lender, excels in multifamily investments and investor education. Ken, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah. So, well, first of all, thank you so much for having me. I'm looking forward to this. This will be fun. So, I grew up in Toledo, got my undergrad at University of Toledo, moved to Cleveland, got my graduate degree from Case Western Reserve while I was a commercial lender. So I spent 5 years as a commercial lender doing all different kinds of loans, and decided I wanted to be a CPA. So that's why I went to school at night at Case Western Reserve. Then spent 7 years at Deloitte. That's where I got all on the tax side. I got all kinds of M&A experience, due diligence, transaction planning, all the really, really cool stuff. It was there that I decided that I'd had enough of watching my family grow up without me, right? Because, and if you know anything about CPAs, man, we work a lot. And Deloitte was a really, really nice place to work. I love working there. Of all the firms, they're the best, no doubt in my mind. But it didn't change the fact that I thought I did everything right, but I just realized that my kids were probably going to grow up while I was working, and that wasn't cool. That's why I got into real estate.
Well, what was the turning point to getting real estate? What was the mind shift?
What was the mind shift? Well, it's kind of goofy, but my daughter was an infant. She was just born. I would do her middle of the night feeding, and that if any parents out there, I mean, that's really cool time. Father-daughter time is the best, man. It's a bond. It's really cool. And I enjoyed it up until the point when I realized, Ken, you're an idiot. It's 3 o'clock in the morning, and this is the best you can do for your kids. So what happened was, I all the time I was at the bank, I had a lot of my clients were in real estate and doing very, very well. When I was at Deloitte, they had a massive real estate tax practice in the Cleveland office. And I saw all these real estate people just doing well all around me. And I thought, I need to do this. I need to make this break, right? So that I can start controlling my life. And it took me about 1.5 years to get there. I mean, back then there were no podcasts like this, nothing. It was Carlton Sheets, no down payment system, and apartment association meetings. That's how I got into it. Tried to figure it out. And I mean, that's how I got there. That's why I got there. I just really wanted a change in my life because I didn't want to, I wanted to be in charge of my own success and my own time so that I could spend the time that I wanted with my family.
Yeah, it's true. They say that the teacher will appear when the student's ready to learn. And it's because the student's just searching for that knowledge anywhere and everywhere, just searching for that teacher. And real estate is, when you know nothing about it, well, really anything, it's where do you get the information to even start learning and just connecting a lot of dots, and you're ever evolving. Tell us what your first deal looked like, and then we'll get in. I mean, you've done over $2 billion in transactions, so we've got a lot to unpack here. But what does that first deal look like when you started to evolve and learn the ropes?
Yeah. My first deal was probably the most stressful thing I've ever done in my life because it was a 28-unit property in a small part of Cleveland called Shaker Square. And I had to sign personally on a $460,000 mortgage. Like that, I mean, that would have sunk me in a minute if this thing didn't work out. That's what made it stressful, right? Imagine you're married, you got 2 really young children, and now you're going to go do this real estate thing and risk everything. Like, really, Ken? What are you thinking? So that was my first deal. It was really stressful. I actually paid an attorney. You talk about this education thing. I actually paid an attorney who had owned a few thousand units, $3,000 just to sort of try to validate what I was doing, right? I figured, well, he's been doing this for a long time. I needed him to do my legal work, right, on the transaction, but I also needed somebody to just say, Ken, you're good to go, man. I think you'll be okay. And he did look at the deal from that perspective. And he did say, Ken, I think you're going to make $100,000 on this deal. And I thought, are you crazy? Like, there's no way I'm going to make $100,000. Are you really? He says, no, you probably will. And I needed that validation because I had to do something to get that lump out of my throat. I mean, I always talk about this. You're stressed out when the lump in your throat feels like a golf ball. And you thought, oh my God, am I getting sick? Literally the moment we closed, it went away. It was the craziest thing.
Well, and it's confidence too. I mean, that
Yeah.
$3,000 is a confidence that you're doing the right move and heading in the right direction. So in all
Yeah.
reality, it is a great investment that enabled you to confidently move forward and
That's
um,
true.
ultimately find out what was on the other side.
Yeah.
Was that a value add strategy? Was it going in and making the property improvements? Tell us.
Yeah, I'd love to tell you that I had this plan and I knew exactly what I was doing. I back then I had no clue. I bought this building, and this is a second scary story, right? If you don't know what you're doing. So I did know a little bit about credit. So imagine I closed. I found a lady who lived there. I gave her a rent credit, and she was able to show the units for me and coordinate maintenance and stuff like that because I was still working at Deloitte. And she would send me these applications for people that wanted to move in, and they were terrible credit. They had evictions, and by the way, we were charging $415 a month in rent, and that included heat. I mean, just think about that. That's pretty low. And I thought, man, what did I do? What did I do? I can't get good people to want to live in this property. And then I met this lady named Karen. I won't use her last name. She was with the city of Shaker Heights, one of the agencies that is part of the city of Shaker Heights. And she said, Ken, let me meet you at your property. Let me just help you. I said, anything. Yes, please help me. Give me a clue. And she showed up and she says, Ken, the building is built in 1930 something, and your kitchens are from 1930 something. She said, Ken, nobody wants to live in a 1930s kitchen. I mean, it might be cool for a minute, but they just don't, right? And I said, oh, what do you want me to do about that? And she says, you gotta fix this place up. You gotta fix up these units. And I said, well, how much do you think it'll cost? This is how clueless I was back then. And she said, it'll be about $5,000. I said, Karen, you don't understand. I borrowed my half of the down payment. I don't have $5,000. Like I'm toast. And she says, look, all I'm going to tell you is you build it, that will come. That was her little saying. I said, okay, all right. I don't know why. I said, look, I got to do something. And I did renovate one unit. I did spend $5,000. It was all on my credit cards. And the very next application, $599 was the rent, and it was a Case Western Reserve grad student. I thought, oh my gosh,
Nice.
she was not wrong. That was how it's embarrassing to admit this out loud, but that was how I became familiar with this value add concept that now, of course, we continue to do even today.
Yeah, but that's where you're learning and you're taking action and learning by taking action. That's how we all really, whether we admit it or not, we learn from just doing it. It's not it's not all just laid out for us to do. So it's so that's huge. So did you end up renovating all the units, or did you tell us?
We renovated some of the units. So then my second building, I said, man, I got to figure this out. And I kept, networking, talking to people, and they said, well, Ken, what you need to set up so that when you renovate that you told the lender you could get, they will reimburse you for the improvement costs. I'm like, oh, this is genius. Like, I'm in. So I did that. That's exactly what I did on my second deal. They agreed to reimburse me for the costs. I just they had to show up and inspect to make sure I wasn't ripping them off and show them a lease and real tenants and everything else. And that's how I financed my second building. We did about half the units there. And the third building I bought, so it was a 28, 24, and the third one was a 22 unit. Really didn't need any renovation. It just happened to be that I got a really good deal on it. But here's what happened. So 3 years in, I sold those buildings and made $500,000. Now that's just ridiculous. Now remember, this is back in the late 90s. I mean, $500,000 is a lot of money now. It was even more money back then, right? So think about that. It was then that I realized, man, I just made $500,000 on the side. That was ridiculous. Imagine if I actually committed full time to this. So I stayed at Deloitte for another year and a half because, I'm just a careful guy. I wanted to make sure that I was comfortable. And then after a year and a half, I did end up leaving Deloitte. And all I've done is real estate since.
Well, and plus you had the inside perspective of what some of the higher players are doing as far as strategies to hedge taxes. I mean, depreciation, of course, is out there, but there's other ways, other strategies you can take on real estate to help hedge. Tell us, I mean, $2 billion worth of real estate, that's a lot. Tell us when you decided to start really
Yeah.
accelerating your growth and know that it's time to, like, you're building an infrastructure, building your foundation. Tell us
Yep.
what that looks like.
Yeah. So the 2 billion, and just to be clear, it summarizes my private equity transactions, my
Yeah.
financing transactions, and my real estate transactions. So your question is, when did I ramp up?
Yeah.
I've really just been slowly. I'm a careful guy, right? CPA, lender background. You would expect me to be a careful, conservative guy, probably too conservative. But for the first 10 years, I built a company in Cleveland. We managed our own stuff because there were no third-party managers in Cleveland, and there still really aren't, I don't think. And I slowly built the company up so that I always had the infrastructure underneath me, right? My motto at the time was find a problem, solve it, figure out why it happened, and then systemically solve it, right? So it didn't happen again. I just kept doing that over and over and over again. And what happens is you start to build processes that allow you to scale. Because even after a couple hundred units, I mean, you can't go and inspect every move in. You just can't. So you got to have systems and processes in place. So then fast forward 15 years ago, I said, you know what? I've done well in Florida, or I've done well in Cleveland. What if I actually went to a market where people really wanted to live, like they really want to go there? And that started our process of going into Florida, syndicating, and then we continue to grow up. Now we do blind pool funds. As of today, we've got about $15-16 million to deploy in our current fund, and we're looking for a deal. So it's just been that slow, steady progression that has been probably slower than it should be, but it was more importantly to me, especially when I decided to take other people's money, I wanted to make sure that I had the infrastructure in place to not screw this thing up, right? Because I don't want to lose somebody else's money.
So what gave you the foresight to move into some of these other places like Florida? Was it just getting market reports, or like what's behind that?
Yeah, well, look, after 10 years in the business, you're starting to learn more, right? You're starting to say, man, this is hard. I got to get a tenant in Cleveland. I got to steal it from the guy next door by giving him a free month. I mean, that's what happens in markets that are not growing when you have supply demand that are not in your favor. And one of the nice things about real estate is I've always liked Florida. I've always wanted to spend time there. It's always been cool. And so I said, okay, well, it is growing. Then I continued my market research. Wow. I'm just starting to understand the demand supply at a market level at that point and realize, okay, wait a minute, there's more people than there is housing. That might be a good thing for me, right? It might be, because that gives me a little boost, right? Whereas in Cleveland, it was the other way around. I had to steal the tenant from the guy next door. We don't steal tenants from the guy next door in Florida. They just show up because they want to be there. And so that's really what got me moving. Now, it took a while to get some traction in Florida. If you think about it, Florida's a big state full of a lot of wealthy people. And here comes this guy from Cleveland. Like, who is he and why should we even care? And, it was a whole very long, slow process to get the market, the brokers, and all of that to take us seriously and start giving us deals. But we stuck with it, right? That's the important thing. You got to be persistent in this business, probably in any business. But this persistence allowed me to get enough traction that I got the first deal, then we got the second deal, and then we did some third-party management in Cleveland, so that all the brokers got to know us really well through that. And then we don't do third-party management really anymore. We've got a couple really nice, great clients that we've hung on to, but for the most part, we don't do that anymore. But we still have these incredible relationships with all these brokers. So that's kind of how it grew up, if that makes sense.
It just started growing through the years, it sounds like, and one thing adds to another.
That's right.
How did you maintain discipline and focus? Because a lot of times you can get shiny object syndrome too as success starts to come.
Yeah.
So did you get any shiny object syndrome, or did you just maintain straight ahead?
Yeah, I mean, I probably did. Well, one of the things that I did right after I quit Deloitte is I learned to fly when I was at Deloitte. I'm a private pilot, and it was if you know anything about downtown Cleveland, we were downtown in one of the office buildings, and Burke Lakefront Airport's right there. And I thought, man, I would love to learn to fly when I was at Deloitte, right? Why not? Well, I don't know why, but that's what I wanted to do. So I would go down to my lunch hour, do my flight lesson, come back, and work the rest of the day as a CPA. Nobody had a clue. And then I realized, wait a minute, man, there's some real opportunity here, right? This would be something I could do in addition to the real estate. So I bought 3 Cessna pilot centers and became what they call a Part 141 school. We would take people from zero all the way to back then it was called the Delta Connection System, right? So we could train airline pilots, and we operated at 3 different airports. And I did this while early on in my real estate career. So is that a shiny object? Oh, it sure was. Very, very shiny. But, looking back, it was really, really helpful to help me understand how to operate a decentralized business, because that's what real estate is. I mean, if you think about it, you're at 3 different airports, you got planes all over the country, and the FAA is inspecting them. Well, you better have your act together, because they'll ground you in a minute if you don't. So it really helped me. Remember that processes and scaling and all that stuff, it really helped me develop that. So in the end, it served me well. But since then, I don't have any shiny objects anymore. I mean, there's no reason to not do real estate and stick to it. It's what we do really, really well. We've done really, really well doing it. And if I can, make the amount of money we have made with a relatively low risk asset like apartments, then we're just going to keep doing it.
Have you ever spun out of just apartments and looked at other asset types?
Not seriously, no,
Yeah.
because I don't know. It's just I know how to do it. We've all of our systems and processes and people. It's all lined up, right? So when we buy a building, I literally hand it to our property management team, and they do it. They just do it. It no longer requires me to spend a lot of time and energy getting it ramped up.
That's having that infrastructure. You've got even your construction crews, your maintenance techs, your everything that it takes to truly operate a property management firm wholly. I mean, there's a lot behind the scenes. There's truly termites, tenants, and toilets. That is true. And having the people, it is. Yeah. It needs to be tended to, and you have to keep your residents satisfied and happy in order to retain them. It's just like any other customer.
That's right.
How many units do you all currently have under your portfolio?
Yeah, I stopped counting. It's probably 800 or so. We've done 19 deals. We've gone full cycle on 14 of them. So we've never necessarily been a unit accumulator. We have found, especially with investors, they like that 3 to 5 year turnaround, because they invested, they got some cash flow, you sold, and you sent them a whole bunch of money. Like, there's no, did we really make money here or not? I mean, there's no question. The deal's done, and the bank accounts are now closed, and they made a lot of money. So early on, and that's what most syndicators generally will do, is they got to prove themselves, right? Yeah. You have to have a few transactions where you actually made money. You can prove to the world you made money. And when you do that, investors take you more seriously, and the trust continues to build as time goes on.
I think it's proving to yourself too, because at the end of the day, is it worth all the effort and energy? And once you have a good exit, a good full cycle deal, then I want to do this again. I want to do this again. It gives you energy to keep.
It gives you massive energy, and your investors love it too. I won't lie to you.
For sure, because it takes time. I mean, it is a slow moving ship if you're doing it right, and you can't rush it, because if you move too fast, and you just give up, you give up a lot of upside if you try to exit or refinance too soon, because you're still burning through old leases and still updating. So it's what are some learning lessons that you've accumulated over the years?
Oh my, there's so many. There's literally hundreds. I would say the biggest lesson, and I've always, remember the CPA lender in me, I've always stuck to the numbers, and the biggest lesson that I think people learn is they tend to get FOMO and lose their discipline. And I have this little saying: we will never, ever negotiate our discipline. We just won't. And even if that means that an investor gets frustrated with us because we haven't found a deal fast enough, I'm okay with that, right? Yeah. Because once you're in these deals, you're not getting out of them unless, you can't just decide tomorrow you're going to sell and it's done. So FOMO is the number one thing that I see people kind of regretting from time to time. We haven't really done that. Other than that, probably the biggest lesson was the Karen lesson that I told you about, understanding the value add concept, right? That was kind of ridiculous that I didn't fully understand that going in. But remember, there was nothing available 27 years ago to learn this stuff. It just didn't. There's so much that I didn't understand that if I started today, oh my goodness, I mean, I think the learning curve would be so much faster because of that.
What are you what are you seeing on the horizon? I mean, we've got we're going to have new leadership at the helm.
Mhm.
What's your feeling, and then what is your deal flow? What are your thoughts on deal flow?
Yeah, I think though, and I just did an article on this recently. I think it really is all about interest rates. So what's happened right now is everything's locked up. It feels very locked up to me. I have conversations with private equity people that they're having trouble raising money because their institutional investors can't exit the deals they're in, which they would use that money. You see, it's kind of locked up. And it's because of these high interest rates. Why do high interest rates matter? Because private equity firms don't want to sell the companies that they own at lower multiples. They just don't. Same thing with real estate. It's no different. So if sellers don't have to sell, they're not. They're just not. They said, look, it's cash flowing. I don't need to sell. Why would I sell into a market that I feel isn't good for a seller to sell? Now, I think as soon as rates come down, now obviously we were all disappointed that the Fed lowered rates 50 and then 25, only to see the treasuries go up almost 100. I mean, that is not what anybody wanted. When those come down, I don't know when. I don't even know what's going to be the catalyst right now. I'm kind of struggling for the catalyst. But when they go down, the market will, there will be deal flow everywhere. And it's because I know that distressed sellers are out there with very kind debt fund lenders who have said, all right, this is a good management team. Let's just stick with them because alternatively, we'll foreclose on the property and take a huge loss. So we're just going to stick it out with them, right? Even though they don't really want to. And then the second is all these people that are holding properties 5, 7, 8, 10 years. They don't want to keep holding. These are good properties. They're going to come on the market because now they can sell at a reasonable rate. So I think the entire system is based on interest rates. We get rates to come down, everything changes.
What does it look like for the buyers though? I mean, the valuations, I mean, we're still seeing deals that would typically trade. They should be trading on a unit price basis on a workforce housing, say C plus, you're going to turn into a B plus, renovate, good area. They're still wanting 100 plus per door when you still have to go and put 15 in per door.
Yeah.
And there's not even a good vision to a good exit. Like, what does it look like when rates come down on that?
Yeah, no, you're right. I think so remember, I'm in Florida, so if I actually found something at 100 a door, oh my gosh, I'd run as fast as I could to get that deal. Right now markets that I'm in are trading more on cap rates. And so, we're trying to go in even leverage. That's around a six cap. When you think about Florida for the last several decades, trading at a 6 cap is pretty damn good. Like if you can buy at a 6 cap, you need to do that. That makes a lot of sense. Is there still buyer seller expectation gap? Yeah. I will tell you that shortly after the Fed dropped rates, the Treasury was like 380 or something, the 7-year or 10-year. I don't remember exactly what it was, but the brokers I talked to had a massive number of BOVs all at the same time, because that's why I think there's a lot of properties waiting to be sold. They just won't sell. They'll sell in the low to mid 5s. They won't sell in the 6s because they probably bought in the 4s. So for me, it's always about cap rates, right? I look at price per pound as well, but remember, I'm in Cleveland. So, the thought of buying something in Cleveland at 100 a door, it just seems ridiculous to me.
Right? Well, I'm in Cincinnati. So that's where Cleveland and Cincinnati are kind of, you got Columbus in the middle.
Yeah. Columbus is probably the best city in the state, but Cleveland's always had a bad rap. I think Cincinnati is a pretty cool town. I drive through it all the time on my way to visit my daughter in Lexington.
Oh, it's a great market for sure. It's just what does the reversion look like as far as cap rate on? I mean, because Cincinnati has a ton of older properties. I mean, it's an older city, and you just keep on building back up. But they're trading at 100 a door. Plus, you need to put 15 into it. Then you need to hold it, service it, and then what does the reversion look like in 3 to 5 years? Is it steady? Cincinnati is a steady Betty market too. So where's the upside?
Yeah, no, you're right. You got to buy it right. In markets like Cincinnati and Cleveland, you have to buy it right. In Florida, you always have to buy right, but you're not going to steal anything in Florida. There's too many people that want to be in Florida. So what matters to me is if I can get in we look for deals that are coming in at close to even leverage and have 200 to 300 in upside. Now, in Cleveland, I couldn't do that in Cleveland. I could never figure out how to do that. $200 to $300 in upside in Cleveland. I mean, you're crazy, right? But it happens all the time in Florida for a lot of different reasons. Right? One, we can physically improve the property. Two, maybe it's just undermanaged. There's so many different reasons. The biggest difference between those two markets is the demand supply thing. It really is a thing. I mean, demand far outweighs supply in Florida. It just does. And that's why we're able to get those higher rents.
Are you seeing like new product coming online and then a saturation issue, or is it there's just still not enough?
Well, maybe. So it depends on where. I mean, we just closed in March of this year on a 102 unit brand new deal in St. Pete, brand new right out of lease up. And I mean, it's a beautiful property. Everybody told me that, oh, you're going to have trouble. There's too much new product in the Tampa market. The problem is I look at the minutia. I just don't look at high level macro stats. The reality of it is where this property is located, there's nothing being built anywhere near it, right? It's all farther east and farther north. And as a result, fast forward, we've been in this deal now 5, 6, 7 months, something like that. And we're full with a wait list and we've moved rents already. So it just depends, right? If you're in Orlando, Orlando's getting hammered with a lot of new supply right now. Some parts of North Tampa are as well. It's kind, you got to pay attention to your markets and know what that is. Other parts of the country like Nashville's getting hammered with new supply. So is Phoenix. See, that's one of the good things about being in Cleveland and maybe Cincinnati is they're not adding a lot of new supply. So you don't have that problem. I do believe that in Florida, the oversupply issue will go away. It will, because it'll get absorbed. People want to live in Florida. I mean, it's just a great place to live. And I just don't see it changing anytime soon.
Yeah, no, I totally agree with Florida. I mean, like you'd said, it's a great place to visit, spend time for sure. It's just breaking into the market, though. A lot of guys can just, I mean, like you mentioned, you're not going to steal a property. And if you're buying for cash flow, for upside, I mean, instead of the coupon flipping returns, that might not be a good market to enter. Because what most people do in Florida, and I watch them do it, especially when we did third-party management, they want to get into Florida. Okay, my goal is going to be to build 1,000 units in Florida, and they would put out a few LOIs, and they wouldn't get any traction, and then they would leave. That's what they do. People do that all the time, and you've got to stick. A market like Florida, you got to stick with it. You got to be there, right? You got to develop relationships. Everything in this world is about relationships. And we've continued to be there. That's why we get deals. Yeah, you constantly show up, and then you prove that you can close, because that's another big thing. Is a broker wants to make sure they're going under contract with someone who's going to close, and that's why we went to the fund concept, right? We used to compete with all the other syndicators as a syndicator, and it'd be, I promise, Mr. Broker, we'll close. I promise. Okay, well, how can I give you the deal? Okay, we'll pay more. That's the only way you can get the deal. Now we've got $16 million to deploy. It's a different story. Now they know we can close. They know we've already raised the money, and they have a long-term relationship with us, right? So we're doing everything we can to position ourselves to be successful in a market where everybody wants to be in. And it just takes a lot of time to do that. Most people don't want to commit that. Are you working with retail investors or family offices or both?
No, mostly retail.
Okay.
Yeah, usually we've talked to a lot of family offices, but they want to write the full equity check. And the reality of it is when you allow that, or when that happens, you really don't. It's not your deal. Yeah. It's their deal. And I would rather work with retail investors and allow the deal to be our deal, right?
Yeah. Yeah, if you're going to spend the time to make sure it performs and be ultimately responsible. Yeah, you want to make sure that you feel the ownership piece too. Yeah, and that's what makes it a little tougher to dispose of the assets. But I mean, that's part of the game. It's as far as someone wanting to break into real estate, what path would you tell them to go down, or suggest that they go down, and then what would be maybe some books that they could read?
Yeah. So what path? First of all, they got to. I mean, I think you alluded to it earlier. We have a whole education side of our business that we created because people were jumping into this business kind of like I did back in '97, not very well informed. And I don't want to see that, because a lot of those people are losing money. And, I'm, 27 years older now. My kids are grown. We now help people get into this business because it's massively changed my life. It massively changes anybody's life who actually gets into it. So what I want people to do is spend the time to learn, roll up your sleeves, do the work, figure out how to underwrite, figure out this is a business, right? It's not just, you're not buying a single or a double. That's the other thing I would say is don't start off with singles and doubles. A lot of people do it because it feels very doable for them. But I'm telling you, it's a very long road to get to real money. If you can start off with multifamily, even with, 2 or 3 partners, that's how you should do it, because then it's going to accelerate you getting toward your goals. I know it certainly has accelerated ours. So
it's a slow mover, though. It's a very slow mover. Be patient, find patient capital, people that aren't influencing you to sell or refinance, just they're along for the trip.
And so stack, what you do is you stack this thing, right? This thing is real estate is a long-term wealth creator. So 27 years later, I have enough passive income. I don't have to do anything, right? That's what happens, right? Then that's what you want. That's what you want for your life. I mean, who wouldn't love to stop working at their choice after 25 years? I mean, it's not my choice because I love doing what we do, but we could make that choice.
That's the game. That is absolutely it. Awesome, Ken. We definitely appreciate you coming on the show. If somebody wants to reach out, get a hold of you, learn more about yourself, how can they get a hold of you?
Yeah, best way is to go to our website, kripartners.com. So it's KRI Partners, that's plural.com. And then just reach out to me. You can get to me a number of different ways from there. But more importantly, we help people create wealth through real estate. Whether you want to do your own deals or you want to do passive deals, we can help you. And that website kind of takes you in both of those directions, depending on where you want to go. And there's a ton of free resources on that site to help you get started and make a good decision.
Awesome, Ken. Definitely appreciate your time. Look forward to following you.